Norms by the market regulator SEBI have been announced for 1 month. Market-wide position limit on F&O stocks may be cut to 50%. The whole idea is to bring down volatility. What the market regulator is also promising is to take stock of the situation regularly. A whole host of new measures that are coming in. Before I get on to all the guests, here's Mubina Kapasi, who's got some time and she's managed to decode some of the actions that has been announced by SEBI. Hi, Mubina. Decode some of the actions that has been announced by SEBI. Hi, Mubina.
Well, after this massive whiplash that the Indian equity markets have got, SEBI has finally stepped in and essentially curbed short selling of stocks. So now FPIs, your institutional investors as well, will not be able to short beyond what they actually hold. So if let's say they hold 100 shares, that's the amount they'll be able to short sell on the derivative market as well. So they've really curbed short selling to that much, and hence most market participants are saying that there could be a bit of a bounce that could come by on Monday's trading sessions. This of course will be applicable from the 23rd of March, that's Monday, and there will be further suitable action that will be taken if needed. And as a part of this itself, SEBI has also proposed to raise margin, like you mentioned, for the non-F&O stocks to 40%. This will be done in a phased manner. But mind you, the proposed margins would be applied only in the cash market, and that will be only for a period of 1 month. And the market-wide position limit on F&O stocks as well may be cut to 50%. That's essentially some of the recommendations come in. So like I said, short selling made extremely tough by SEBI. Short selling by FI, MF is limited only to their actual portfolio holding. Remember that we are not the only ones who've done this. China, of course, has curbed short selling to a significant manner, which, explains why sometimes their markets in the last 1 month were resilient when the rest of the equity markets were falling. Other countries as well have done that. Now India too joins the list after the massive whiplash that the Indian equity markets have received in the last 1 month.
Let me go across to our managing editor Nikunj Dalmia for more on this. Nikunj, we have seen some market participants saying the market regulator needs to act, bring down volatility, take some action against short selling. We've seen a couple of European domiciles do this. What did you think of the measures that have been announced by the market regulator? Are they significant? Will they have a big impact?
Nantara, what is the regulator trying to do? The regulator is simply trying to make life slightly difficult for the short sellers. You may say that this may not be the best practice to do because ultimately markets, they have to find their own level, and a curb on short selling or, to make life slightly difficult for short selling is not a permanent solution. But given that markets have been in free fall, there are no buyers on one side, traders are taking advantage of this nervousness, the volatility is extreme on both the ends, the market is behaving in a typical pattern where, value is getting eroded, not because fundamentally stocks, they deserve to come down, but they're getting down because of sentiment. So in the short term, it's more like a band-aid approach, is going to plug a hole. Now, how will markets react to this? The way I look at market reaction, well, you may see a gap up start. You may see a little bit of relief. You may see liquidity coming back in the F&O market largely because of short selling. But ultimately, like water has to find its own level, markets will have to find their own level. I mean, somebody wants to sell in delivery, you can easily, sell delivery if you are an institutional investor. The idea here is you are essentially trying to stem the market fall by banning or making short selling difficult. Now, I may also argue back and intellectually say that is this a good strategy, because then what happens to somebody who wants to hedge their portfolio? What happens to somebody who genuinely feels that market should go down given what is happening in the world? So I've never been a big fan of these, it's not a curb, but this kind of a move. But frankly, given where the markets are and the selling has been one-sided and the selling has been very ruthless and very brutal and it's been excruciating, this is just going to stem the market fall. In the short term, Mubina and Antara, my view is that you need to stem the fall. Let the market calm down. 10, 15 days, 20 days, when we will get good medical news, that will act as a circuit breaker. But if stock prices, they keep on coming down, a feedback loop will start where stock prices will start having impact on economy rather than economy having impact on the stock price.
Nikunj, before we also go to our guests, what I would also like to ask you is that so far the release that has come out doesn't provide a lot of details on what's going to happen in the stock exchanges and the Lal Street come Monday. We've seen the Thakres the Chief Minister talk about how there will be exemptions of financial services as well as the stock exchanges. But what happens to brokerage firms? Will they be allowed remote trading and positions and all of that? We don't have clarity on that. Isn't that something else that all market participants will want from the market regulator?
No, I think it's given that you cannot shut down the financial markets, and financial markets should not be stopped. Yes, I understand that if 25% of the total, if there is a mandate that less than 50% of the total staff members really have to reach, it's going to make life slightly difficult, especially for back office people, because back office necessity is required. You can trade from home, you can analyze stock portfolios from home, you can give orders from the phone, but institutional orders work in a separate manner. The traders have to be there to receive orders. The trader need to be in the dealing room to get orders. Orders have to be executed, orders have to be recorded. So on that account, I think definitely there's going to be impact on the institutional side of the market. But in all fairness, these are extraordinary times. Extraordinary times, they need extraordinary measure. So I think we should be a full votary of what the government is trying to do. And I don't think financial markets will get really impacted, because bear in mind, a lot of transactions have also moved on to digital. Gone are the days you had to go to a bank branch and to deposit cash and take cash back. So on that account, a lot of transactions are moved digital. A lot of HNI portfolios and retail portfolios can be traded online. But I understand that for institutional investors, where they need to maintain a record, they have to follow certain international guidelines, best practices have to be followed, documentation needs to be done. That's a back office work, and that may slow down and that may take a hit. But I'm sure in today's time when cloud and other things and video conferencing can collect people, you can find a solution. As long as there is a will, there is a way. I'm a firm votary of that.
Where there's a will, there's a way, and of course, health is the ultimate wealth, and even more important than what you might make from the stock markets. But stay with us, Nikunj Dalmia. We're also being joined by Sunil Subramaniam as well as Sandip Parekh for their expert take, and I'm sure you'll have questions for them. Sunil Subramaniam, if I could come to you first. You've seen this important release that is coming from the market regulator, trying to curb volatility, trying to reinforce, trying to curb norms when it comes to short selling as well, make it more difficult, rein in sanity maybe. What did you think of it?
I think it's a very good move, because you see, just in a fortnight, the VIX has moved from 11 to 68. So essentially what this has done is, let's take a mutual fund example. We are essentially buying for the long term. But there is a regular daily NAV published against the benchmark, and there is a comparison against peers. So if I see a good quality stock, and I feel in 3 years is a good time to buy, but what happens is that the very next day I get proved wrong, because the stock falls even more and the NAV comes down. So then there is a natural hesitancy which comes. Though I know it's a good buy, am I going to get it cheaper tomorrow, day after? Do I buy it today? This uncertainty in the minds of genuine investors, which I would call mutual fund genuine investors, and I'm sure even in the retail buyers, there are genuine investors. For a retail genuine investor, then, the immediate pain that follows that volatility is pretty tough. So it makes them stay away and wait and watch till the situation comes out. So this absence of regular investor is furthering the market fall. So I think that's where I think SEBI's move is very good, because with this, it means it's made it much more difficult with the cash margins increasing, with the open positions being controlled. It makes it much more easier then for a genuine investor who sees a good stock and a good value in it to actually go and say, okay, over the next few weeks, yes, the health concerns could lead to a revision in earnings estimates of various companies because of the economic slowdown. All that is a part of fundamental analysis. But at least once I've got my analysis ready, if I'm ready to buy, I shouldn't be, panicking, saying, hey, this will be 5% cheaper tomorrow, 10% cheaper a week later. So I think that's where the market regulators move. I would welcome it and say it's a good one.
Whereas I'm a big votary that right now you have to calm this sentiment, and if the medical news improves, maybe markets automatically will bounce back, and this entire excruciating fall, which has happened largely because of short selling, will benefit us. But Sandeep, is it a good idea to perhaps come up with these rules? Because ultimately markets have to discover their right level. The bulls may call it panic, but the bears may see this as an opportunity. Sandip Sabharwal?
So actually, I was also trying to go through this entire thing in detail. So what I understood is that on one side they are trying to curb volatility via stock future trading, so reducing the market-wide limit for individual stocks to 50%. So which I don't think is a bad move in the short run, and they're doing it for a month only, which is good. Because that so unnecessarily people won't come and buy and sell every day in the futures and options market. The second thing is that they are effectively saying that if you are going to use index derivatives, it can only be used to hedge. It cannot be used as a directional tool. Now, like you were saying, as someone who would believe in free markets, one would think that if some facility was available, it should ideally continue, because ultimately it's not only Indian market which are falling, it is all the entire global market which is falling. So when shorts become overconfident, they go excessively short, and then some positive news come, then that's what creates the short trap and the bounce back. But I think what they have been perturbed about is the volatility which is happening, which is not unique to India, which is happening globally. So that's why they have taken this action. But they have also said that some additional limits will be available of 500 crores on the index futures and options contract. Now, which I am not sure whether it is overall for the market or for one participant. So that is something which we need clarity on. But what it could do in the short run, obviously, is because they are saying that what they are saying is that these restrictions will be valid till the expiry or till the nearest F&O expiry. So I think which is just 4 days away. So it could lead to some forced short covering, because obviously index, if you see the Nifty also, it's at a discount. Many stocks are at a discount. So obviously there is huge amount of shorting which has happened. So that could happen. But directionally, subsequent to that, the market move will depend more on what's happening to the entire COVID issue and the measures being taken by global governments and central banks.
Let's understand, for institutional investors, they can't go short as it is. Now, it is HNI investors who may want to go short. Now, do you think there are enough short positions in the market, and will this lead to some degree of reversal where shorts may be forced to run for the cover? Sunil Subramaniam?
Yes, because I think the automatic carry forward of trades would not be limited, because if the open positions are exceeding, he will have to cover it. So this will lead to all those positions, and I think it's pretty market information is pretty available on what the positions are. So wherever it's in excess of 50, you know that all those have to, near term, guys have to cover it, because you can't take more than 50% is what they're saying. So yes, what you say is correct. It will lead to a bounce back in a lot of short prices because of short covering.
Sandip Parekh, as a votary of free market, and I'm simply asking you a philosophical question. Before you answer that, let me make our channel stand very clear. According to us, SEBI has done the right thing because the pain was getting excruciating, and these are extraordinary situations which demand extraordinary measure. After having shared my views, Sandip, I want to understand your view.
Hi. So I have very quickly seen the circular, so I don't want to get too much into the depths of what they're articulating. But broadly, I think SEBI's lookout is not at deciding levels of the market, and I think they're pretty sophisticated for doing something which will actually decide the levels or kind of ban one side of the market or the sort. I think their main lookout is to protect the market from volatile times in terms of, the clearing corporation being safe at all points of time. And I think that with that in mind, they've introduced increased margins, increased safety, market-wide position limit changes, etc. So that seems to be the theme of SEBI, that, we want to make sure that there's no solvency issue at any stage. and they're not trying to set a market level and prohibit particular kinds of short trades.
Okay. Nantara, Mubina, I think we must put the backdrop here for the context of our views. And gentlemen, thank you all for joining us. Mubina and Nantara, we must put the backdrop here. The backdrop here is that what SEBI is trying to do is what all regulators globally should do, which is try to stem the volatility. The regulator will never intervene in a price discovery mechanism. Stock market is a platform where price discovery takes place. Shorting and going long, I think these are part and parcel of any free market. So I don't want our viewers to take this wrong that, okay, SEBI is trying to artificially curb any prices. The attempt here is to take the volatility out, given that this volatility in last couple of days has been extraordinary. We are looking at volatility which I think financial markets have not seen in last 30 years. And what you've not seen in last 30 years, I guess that kind of volatility at a time when the base of the economy and the base of the stock market has become large is costing A, stock markets, B, investors, C, retail investors dearly. So the attempt here is to really curb the volatility, because we are right now reacting and acting to sentiment and less to fundamentals, because everything in the world currently is moving as per the medical news. So I think this is a step in the right direction. Will this really change the contours of the market in the short term? I don't know, but I'm reasonably confident, Nantara and Mubina, that this will definitely curb the volatility. With that, back to you guys.
Okay, so that's Nikunj Dalmia, our managing editor, making it quite clear that you will see a curb on volatility. That's what it's aimed at, and in that sense, a good move that is coming in from the market regulator. Ladies and gentlemen, with that, we're going to take a short commercial break. But stay tuned. You're watching this special broadcast of News Now. Lots more to discuss on the other side.